Hi everybody, this is Gary Dean and this is our weekend video report for Sunday, April 10th, 2016. I hope you guys are having a fantastic weekend and let's get started. So Friday they did try higher, but then we saw some selling and that took place right at the resistance, and the Nasdaq actually closed down. S&P was up, I think, about 5 points or so, but nothing major. And the patterns that I've been showing that I'll go over in the charts, they're still in play. It would have been better if we would have, seen the markets head down further on Friday, but they're going to do what they're going to do. It still doesn't make, say, the long side safe. I think it's actually very vulnerable on the short term. So some of the reasons, first you can see this is selling the strength. Spiders were the number one spot on Friday. We saw the money flow was minus 1225, and as far as the block trades was minus 1221. So there was selling going on, from the big boys. Now, when we take a look at just our regular, say, market breadth charts here, you can see that we're very, very overextended on the advanced decline line. I've been, talking about this for a while, and it's what it is. It's red flags. It just means that you just can't really be too, say, comfortable on the long side, but price has not really reacted to them. So it's a warning sign. It will actually, be a real, say, threat once price reacts to it, because typically when we've been at these levels, we have seen much deeper drops, and we have not seen that yet. So this is, still remains, in, say, red flag territory. When we take a look at the put call ratio here, we can see that it made the, it jumped up here. So that meant that we saw some put buying. And typically when we get that, we see at least 100-point drops, sometimes even more than that. We didn't get anything. It was a one-day little drop, and then we came up and made new highs. So we have a bearish divergence with it, where you can see the put-call ratio made a higher low as the S&P was making a higher high. So again, another red flag. And now you can see it's turning back up. So maybe price, it's exhausted. So maybe we do see price react to it. But again, we haven't really seen that yet. And the only thing we could look at it is, it's a red flag, and that the upside is very, very vulnerable. But again, until price reacts, it's just going to remain just a warning sign. Taking a look at the bullish percent, again, we're at levels that, and it's probably why we're seeing the S&P run into some issues here as far as breaking out, because when we're up at these levels here, this is when they top out. And you could see it when it was here and it kind of just hung out up here. We were making higher highs, but they were barely higher highs, and we kind of just went sideways. And then from there, everything collapsed. So we're at levels that it's tough for the bulls to push higher, and especially since the S&P is at resistance. So let's take a look at our regular charts here. And looking at the S&P on a daily chart, again, we have the bearish divergences. So when you combine that with the red flags that we're seeing with the market breadth and how overextended it is, it makes things dangerous. And we saw the S&P reverse right in the resistance zone, and if they're able to pop higher, then the next resistance is going to be 2104 and then 2116. So even if they get through here, you still have these resistance here. And again, they're moving on bearish divergences and very overbought conditions. Taking a look at the Qs, they closed down on Friday, and we're hovering right near that 78% retracement level. We don't really have the extended bearish divergences like we have on the S&P, but still very overextended right here. And we're at resistance. They still have not closed the gap. And that's right around that. I can give you the exact number. The low is 111.84. So possibly, I've been saying that with the technology or Nasdaq that has been kind of lagging from these lows. This is kind of what's been holding the market up. But even though Friday the Nasdaq was actually down, or the Qs were down, they still have this gap that's up here, and they may try and fill that before we see any larger move to the downside. Now, they may come and try to close this at a later time and pull back some and then head up. That would actually be a better fit, because it would allow the S&P and the Dow to, really take a well-needed rest and pull back a little bit before heading higher. But again, this gap right here, you got to keep an eye on it, because if history is our guide, they typically don't move down that hard until gaps are filled, and that's why we want to keep an eye on this level here. So if we take a look at the Dow, again, this right in this resistance zone here, it reversed. It's right at the 78% retracement. So a typical retracement we would see the Dow coming down to the 17,113, or possibly even down to the 16,900. This would be a decent retracement before they try higher. And the fact that we have, our 200 move is sloping down, it means that we're still in a in a bearish type market right now, and we have the 50-day that's below the 200. So even though we've had these big moves like we're seeing here, when the moving averages are below each other and the 200 is slanting down, typically, it's going to continue in that direction, and you can see the same thing happened here. Once the 50-day started moving up like it is now, this is when we came down, did a test of it, and just kind of bounced around up here before finally collapsing. So if we take a look at the 15-minute chart on the S&P here, I was showing you where we had the 1, 2, 3, 4, 5, and I labeled that an A. Then we had 1, 2, 3, 4, 5. I labeled that a B. And this very well could have been the C, because it was just an ABC move. So the way that I would actually view it is this would be just a larger wave A. We now made a larger wave B, and now we're going to come back down and make a larger wave C. Now the reason why I like that is because A, we have this head and shoulders pattern that the target brings us down someplace into the 2005 area, and possibly even down to that 1990. And it would make more sense if this is the pattern that's going to be playing out. Now, also, what we want to notice is this bounce on Friday. First of all, 90% of it was done in the opening gap here, and then from there it reversed right at the 78% retracement. So remember that this is typically where reversals take place. This bounce here stopped right at the 78% retracement. This one here stopped at the 78% retracement. So really what we need is the bears to push it through this 2033. From there, I believe we head down to this 2000 and say 2010 all the way down to possibly close this gap at 1992. And what the bears need to do is the bulls have to do is push it above this Friday's highs, above the 2060, and from there it would leave the door open for a test of the 2068. But again, the weakness that we saw right at the 78% retracement is leading me to believe that there's the bulls are out of gas right now, and especially with the selling that we're seeing on the strength from the money flow, as well as just our market breadths that are just at levels that it's very hard for the bulls to push higher. I do believe the next, say, larger move from here is going to be to the downside. So don't want to sound, again, like a broken record, but it's, we just kind of have to wait for price to break, and I do believe it's going to. It's, just a matter of when they decide to do this. So with that, enjoy the rest of your weekend, and I will talk to you guys tomorrow.